Hello everyone, welcome to the 5th episode of me learning to trade with Forex. So in the last video, I guess we started working through the official Forex course, so the official beginner course, Introduction to Financial Markets, listed on the Forex website. We've been going through like the first two of them, and then now we're on the third. So we've done all this bit. We've done all the majors, minors, and exotic currency pairs, and now we're currently back on this bit. So yeah, let's get going. What moves Forex markets? Lots of different factors can affect individual currency pairs' price at any given day. Some common examples include economic data. Right, so factors which affect factors which affect currency pairs price include economic data, central banks, politics. So economic data. Currencies tend to reflect the economic health of the parent nation. Yep, so critical economic data such as inflation, unemployment numbers, foreign trade or payroll numbers can often result in Forex volatility. So economic data such as inflation, unemployment numbers, foreign trade or payroll numbers all cause volatility. Central banks can have a big influence over the performance of currencies, for example by changing interest rates or printing more money. Central banks can adjust interest rates and print more money, which affects the performance of the currency. They may also buy and sell their currency to keep it trading within a certain level. They may also buy and sell their currency to keep it trading in a certain level. Politics. Increasingly, political uncertainty can drive a currency market. The US dollar, for example, has traditionally been seen as a safe haven currency, so its price may rise during troubled times. Safe haven currency. Political uncertainty can drive currency markets. US dollar is seen as a safe haven currency, and so its price may rise during troubled times. Alternatively, something as banal as a speech by a finance minister can have a big impact on currency.
An important first step in trading Forex is to understand what makes currencies move. We've identified 3 key factors which you should keep an eye on. Firstly, central bank interest rates. A huge influence on exchange rates are central banks and the decisions they make on interest rates. Put simply, if a central bank raises rates, it can mean the economy is growing and the outlook for the future is optimistic. If it cuts rates, it can be a sign that growth is faltering. During rate announcements, traders try to make a call on whether a rate may change, in which direction, and by how much. Traders will often also try to glean insight about what a central bank is likely to do in the future from its accompanying monetary policy statement. Then there's central bank's occasional use of unconventional monetary policy. Japan, for example, is dependent on exports and doesn't want to see its currency, the yen, gain too much value. This would mean less profit for its manufacturers, and so the Japanese central bank may decide to increase the supply of its currency and thus dilute the yen's value. There may sometimes be clues that intervention is about to be implemented, particularly if a central bank repeatedly states that its currency is historically overvalued. News reports and announcements can also affect the direction of the market. Even unsubstantiated rumors may create strong price movements. Part of your job as a trader is to recognize what will and won't make the market move. Certain economic events are likely to lead to bigger reactions. These include employment reports, retail sales, and inflation announcements. To help, our comprehensive economic calendar provides an idea of which events are likely to cause price movements. You can access it on the Forex.com website.
So getting to know what happens around the world is really, really important then. Right, okay, so making a first Forex trade. Now you know a little bit of Forex, we can take a closer look at how to make a first trade. If you have Forex.com demo account, you can follow these steps open. If you haven't, open a text and cost nothing. Select a currency pair. Most new traders will focus on one of three headline majors: EUR/USD, USD/JPY, and GBP/USD. But you can trade any currency pair that we have available as long as you have enough virtual funds in your demo. Analyze the market to decide whether to go long or short, as well as what strategy to take. You might look at current and historical charts, monitor news for economic announcements, or consider applying a few technical indicators. Take a look at recent news on the EUR/USD. Are there any clues to its future price action? We'll take a closer look at the technical and fundamental analysis later on. Read the quote. Like most financial markets, Forex pairs will have two prices listed in their quote: base and the quote. Sell, buy. Sell price, buy price. The first is the price at which you can sell the currency pair. The second is the price at which you buy the currency pair. The difference between them is called a spread, which is the amount that the dealer charges for making the trade. Take a look at the EUR trade ticket by clicking on its market name. You can sell the currency pair at this, or you can buy it at 1.0719. Pick your size and position. The size of your trade determines how much of the base currency you're buying or selling. So this bit here, and how much you'll make or lose for each pip that the pair moves. Choose a buy position if you believe that value of the base currency will rise compared to the quote currency. So basically, the USD. So if you believe that it will rise compared to, so USD is gonna increase. Choose a sell position if you believe that value of the base currency will fall compared to the quote currency. Why does that close your trade? Close a trade, you trade in the opposite position to when you open it. To close a Forex trade, you trade in the opposite direction to when you open it. So if you bought it, then you would sell it. But if you buy it, you would sell it. If you sell it, I mean, you would buy it. If you use the buy trade to open, you sell to close, and vice versa. To sell euro. Test your knowledge. The Federal Reserve announces that if it's raising interest rates, what might that mean for USD/JPY? So if it's raising interest rates, then that means the economic health is pretty good. So if the economic health is pretty good, then if the economic health is pretty good, it is raising interest rates. If the interest rate goes up, I wrote this in a note somewhere, I remember. Suppliers, how much? So will go up, right? Because our attract the piece of his, then it will encourage investments to increase demand. And if there's an increased demand, then if the demand rises, then the price will usually rise. Yeah, so if the demand rises but supply doesn't, then the price will usually rise. Hence, this will go up. The UK government releases economic that shows booming employment growth. What does that mean for? It'll go up. Wait, booming employment and growth. The UK government releases economic data. So GBP is on the rise. If GBP is on the rise, then it will go down. Because the quote currency is doing well compared to the base currency. Go to the next lesson. There we go. What are shares? Shares are best known financial market, one of the most popular among individual investors. What are shares? Shares are literally just that, a share in the ownership of a company. So a share shares are a share of ownership of a company. Owning shares means that you own part of a business. Owning shares means you own parts of a business. I just realised shares, all these other sections, shares, indices, commodities, they're not Forex related. They're not Forex, but I guess they're still Forex related because it's all falls under the financial markets umbrella. So it's still good to read about this just to get like a wider range of knowledge. So your own part of the business, if its value increases, so does the value of your shares. If the share, if the value of the business increases, the value of your share also increases. You may also be entitled to some of the organization profits via dividends or to vote on company matters. Oh. May also be entitled to some of the company's profits via dividends or to vote on company matters. say, for example, that Apple's ownership is broken down into 1 billion different shares. If you own 100 Apple shares, then you have a 0.1% stake in the ownership of the company. As Apple's values goes up and down, so does the value of your shares. Because shares provide the owners with a stake in the company, they are also referred to as equities, or the equity market. So, because shares provide their owners with a stake in a company, they are also referred to as equities, or the equity market. This is to differentiate them from bonds, which are also issued by companies but do not provide equity. You may also hear shares referred to as stocks. Because shares provide this is differentiated from bonds, which are also issued by companies. So what's bonds then? But do not provide equity. Bonds do not provide equity. You may also hear shares referred to as stocks. Shares equals stocks. Companies sell shares because they want to raise capital. Companies sell shares, so they want more money, basically. Sell shares because they want more capital. Often this is to fund further expansion, but sometimes it's so the founders can cash in on their company's success. Instead of borrowing money in the form of a loan or bonds, they can choose to sell a stake in their company, diluting their ownership in return for a profit. This process is known as listing. So listing is when the owner of a company sells its shares to make a profit, right? Total profit, yeah. Did you know not all big companies are tradable shares? There are some very large ones, including not all tradable shares, including famous household brands that are still privately owned. When a business has shares available for trading, it is known as a public company. When a business has shares available for trading, it's known as a public company. In addition, some bigger companies only list a portion of their shares, while the rest is kept in private hands or owned by governments. The listed position is called the free float. So only list a portion of their shares, known as the free float. Rest is kept in private hands or by the government. Who trades shares? Lots of different people, companies and institutions will hold shares. Banks, pension funds and professional investors will buy and sell stocks as a means of generating profits. Equities, or shares, right? Yeah. Are also popular among individuals who use a broker or a leverage trader to take long or short-term position of stocks. Different companies will perform very differently on the stock market. Established businesses, for example, may not see much volatility in their share prices, but smaller, lesser-known stocks can see massive growth or disappear without a trace. This means that equity markets have something to offer almost any type of trader. Pension funds with low risks profiles can stick to blue chip companies. whilst risk-hungry treasure hunters can search for gold among penny stocks. So you can either go big, go home, or stick with the safe one, basically. Why trade shares? Just like any other financial markets, the vast majority of share trading is undertaken with the aim of earning profit. Yep. There are two main ways to make money from stocks: selling your shares and dividends. Two main ways to make money. Selling your shares. Dividends. Sell them for a profit. A company's share price is a reflection of its perceived value in the market. Company's share price is a reflection of its perceived value on the market. Many investors will try to find companies that they think will grow in the coming months and years and buy shares of them. Then they can sell these shares for profit when the company has achieved success. Of course, if the company never grows, then your shares will never make a profit, and you may have to sell them for a loss. Dividends. Many companies will also pay out dividends to their shareholders. A dividend is a share of the organization's profits that is paid back to its owners. A dividend is a share of the organization's profits that is paid back to the owners. A dividend is a share of the company's profits which is paid back to the owner. Companies are not obliged to pay in dividends, but many do so. These stocks are prized because they offer income as well as returns. Dividends are usually paid out on a regular basis. Cool. Technology. Is Microsoft a private or public company? You can buy shares from them, can't you? Yeah, you can. Is Audi a private? Oh, it's a private one. Oh. Is Walmart? That's a public one. Is Nintendo? That's a public one as well, isn't it? Is IKEA? That's a private one. Trading shares. In this lesson we'll take a look at how global stock exchange facilitate billions of dollars worth of share trades each day, and how you can take part in the equities market. Where are shares traded? Equities. Shares are traded on stock exchanges. Shares are traded on stock exchanges. Markets are built specifically to handle the buying and selling of stocks. Almost every country on the planet has a stock exchange for public companies, and some have multiple. Stock exchanges are not open 24 hours a day. Ooh. Stock exchanges are not open 24 hours a day. So you can only buy and sell shares on the exchange that they're listed on is open. List of major stock exchanges. A few notable stock exchanges include Tokyo Stock Exchange, London Stock Exchange, Nasdaq, NYSE. London Stock Exchange. NYSE, country US. Hours 9:30 to 4 p.m. New York time. The New York Stock Exchange is the biggest in the world by the value of the companies listed on it, which are worth over 30 trillion. Founded in 1972, notable stocks on the NYSE include Coca-Cola, Goldman Sachs, and Walmart. Is that pronounced Sachs? Nasdaq, country US, hours 9:30 to 4 p.m. New York time, same time. There are also located in New York. Yep. The Nasdaq is the second biggest stock exchange market in the world. Founded in the 1970s to facilitate electronic trading. Today it is the home of some of the world's most valuable tech companies, include Apple, Microsoft and Amazon. Tokyo Stock Exchange, Japan, 9 a.m. to 11:30, then 12:30 to 3 Tokyo time. TSEs are Japan's primaries and the biggest in Asia. Nintendo, SoftBank, and Honda are all listed on it. Ooh, Nintendo, SoftBank, and Honda are all listed. London, the Stock Exchange, 8 a.m. to 4:40 p.m. London is around 450, making it one of the most venerable in the world. Venerable. What are stockbrokers? Stockbrokers are companies that invest in stocks on their clients' behalf. Stockbrokers are companies that invest in stocks on their clients' behalf. Stocks exchanges have rules on who can use them to buy and sell shares directly. For most individual investors, that means using broker. There are three main types of stockbrokers. There are three main types of stockbrokers. Execution only. Execution only means which only acts on your instruction. Advisory means which they may recommend specific trades. Discretionary, which they'll execute trades without any input from you. How do companies they may recommend execution. How do companies list on stock exchanges? When a private company decides to list and go public, they'll join a stock exchange in a process known as an initial public offering. Initial public offering. Initial public offering is when a private company decides to go public. To list and go public. This is when a company's stock is first issued. Markets often get excited by IPOs, as this is the first time retail investors can take their view on a company. Public companies are subject to more regulations than private ones, so preparing for an IPO can take some time. Once a business is ready to list, they'll typically offer their stock up at a set price, and investors can apply to buy shares. Then once the listing is complete, shares in the company can be bought and sold as normal. Ticker symbols. You'll often see prices for listed shares in the form of tickers. Stock ticker symbols are a shorthand way of writing the names of stocks when listing prices. So, stock ticker symbols are a short-handed way of writing the names of stocks when listing prices. Oh, is this like, so for Amazon it's going to be like AMZ or something like that. usually consisting of the exchange listed on by 5 feet. Apple, for instance, is Nasdaq, AAP, or Lloyds Bank. Meanwhile, it's Lloyds SE. Oh, right, okay. When listing, is listed by a few letters, isn't it? Usually considers it's listed on followed by a few letters. It's and oh, because this is the exchange. So this is the Nasdaq place, and this is the London Stocks Exchange, and then Apple, Lloyd's. Right, okay. It's Nasdaq. AAPL. Market caps. A company's market cap, short for market capitalization, is a total value of all the outstanding shares it has on the market. Market capitalization is the total value of all its stocks, which is value of all the outstanding shares it has on the market. To calculate a stock's market cap, you could take the total shares as available for trade and multiply the current share price. So it's market cap is equal to outstanding share times by price of each share, right? Current share price, yep. Just close off. Right, okay, so save it. What affects the price of a share? Share prices are constant moving as demand fluctuates for different economies, industries and companies. So here are a few factors I like to call stock market volatility. Right, okay, so where do I write this? Was this? So factors which affects the price of a share include earnings, news about a company, external factors, corporate actions. Earnings. Listed companies will report their revenue, profit and more on a regular basis. Put their revenue, profit and more on a regular basis. Isn't that like on the like company reports or whatever? Yeah, def report. Usually core like financial reports, I think that's what it's called, with an in-depth report once a year. Dev. So, so this could mean that if a company is making more profit, then its shares going to become more attractive for buyers to buy. And if there's more people trying to buy it, then that means there's an increased demand. But the supply is still going to be the same, so the price of the share is going to raise. Ah, right, okay. Is that what it means? Listed companies. Let's go through these in detail, looking to discover how companies performing now and how they are performing company in years. News about a company. Positive, negative headlines surrounding payout, a share price. New product announcements, changes in management, scandals for the price. Volkswagen emissions scandal on 20, for example, hurts the stock price significantly. What OHL? What do these numbers mean? High low? Is that what it means? High low? Currents. This means current, right? So higher current is this bit here, isn't it? What does O mean though? Earnings. So positive slash negative news can impact share price through new product announcements, changes in management, or scandals. External factors. News regarding a company's economy, industry, peers, and trading conditions all affect demand, therefore share price. In fact, stocks in a given often perform similarly as they react to similar headlines. Companies, economy, industry, and peers. Peers and trading conditions can all affect demand. Stocks in a given industry often perform similarly as they react to the same headlines. So like all the food companies will, well I say might perform all similar because they will, so if anything regarding food comes out, say like with all the I don't know, the cheese companies, and suddenly like the price of milk increases, then all of them are going to be affected the same way. Corporate actions. The life of a big company is rarely smooth, and there are a number of important events that affect the price of shares. These include mergers between corporate actions. Corporate actions such as mergers between companies and the acquisition of one company by another directors' dealings. Oh, what is done? Directors' dealings. When directors buy or sell their own share in the company. Rights issues. When companies issue more shares to the market to raise money. Companies issue more shares in the to raise share buybacks. When a company reattracts the shares from the market, when a company starts buying up its own shares. Special dividends. Dividend paid out by companies when they are feeling particularly cash rich. Ooh, they are feeling particularly cash rich. Share splits. When a company splits shares into smaller ones, often because they're becoming too expensive. Ooh. Company splits shares into smaller, often because they're becoming too expensive. Right, okay, so in price. So I guess these are some of the factors which affect the price of the shares for a corporate. So for the mergers between company and companies by another, would that increase or decrease the price of the share? That might mergers being, so if a company gets, that means the company is going to get bigger. If it gets bigger, that would mean there is more supply. Right, no, yes, more supply. But would the demand still be the same or increase, or would it increase? If the supply if the supply increases and the demand also increases, then the price is still going to increase. But if the supply increases and the demand is kept the same, then the share price might go down. Directors' dealings, when directors buy or sell their own shares in the company. So if the director does buy their own share, then that would mean there's more demand. No, there is less supply and higher demand. So if there's less supply, higher demand, the share price is going to increase, right? If they buy it. Or if they sell it, then there's going to be more supply and less demand, so the share price is going to decrease. Rights issues. When company issues more shares to the stock market to raise money, so there's going to be more supply same demand. If it's same demand, more supply, then the price is gonna drop. Share buybacks, when a company starts buying up its own shares. If it buys back its own shares, then there's going to be less supply and there's more demand and less supply. So there's more demand, less supply, then the share price is going to raise. Special dividends. A dividend paid out becomes when a feeling pretty cash rich. That's going to increase the price of the shares, right? No. If the company feeling particularly cash rich, how would that affect the price of the share? Wait, so if that means that more people are going to be attracted to buying the shares. If more people are buying, then there's a higher demand, but with the same amount of supply. So if there's a high demand with the same amount of supply, the price of the shares is still going to raise. Because it's still the same amount of supply, but there's a high demand for it. Because everyone's trying to buy that share because the company's trying to pay out higher dividends. Yeah, so the price of the share is going to increase for that one. Share splits, when a company splits shares into smaller ones, often because they're becoming too expensive. Shares into smaller ones, so there's going to be more supply, same amount of demand, there's more supply, same amount of demand, the price of the shares is going to be cheaper. Test your knowledge. ABC PLC has 1 outstanding current share price of what's market cap. That's that times that, which is 102030405060. So that, oh shit, that, nice. Okay, so everything's learnt about the shares. How are we doing the recording? 47 minutes, right. This is a good bit to end because we've actually finished the whole section, you know, not just left it partway through the page, but yeah, cool. Yeah, that's all for today. Thank you for watching. I will see you in the next video about indices. See you later. Bye bye.